Good afternoon, everyone, and welcome to today's class called Passive Activity Loss and At-Risk Limits. Today's class is going to cover, by and large, contents included in IRS Publication 925, which covers passive activity and at-risk rules. We're also going to be looking at Forms 8582 and 6198, and you can reference those forms and their instructions on IRS's website under the instructions for each of those forms. So essentially, we're getting the content of today's class from those three main sources and a few pages of Pub 17 as well. Now, the baseline or the beginning point for today's class is really understanding that in order to apply the at-risk rules and the passive activity loss rules, you need to be looking at passive income or income from a business activity and whether or not you are going to be able to claim deductions for losses that you have. So today's class is about the type of business activity that would generate a loss and whether or not you are allowed to claim that loss on your tax return. And we're going to begin with a discussion of at-risk rules. If your rental property or other business activity results in a net loss for the year, you may use the loss to offset other income only if you are at risk for the money lost in the activity. You are considered to be at risk to the extent you have after-tax amounts invested in the activity that have not previously been deducted on your tax return somewhere else at some other time. Figuring your allowable loss. Generally, you must complete Form 6198 to figure your allowable loss if the following is true. You have a loss from an activity carried on as a trade or business or for production of income, and there are amounts in the activity for which you are not at risk. And you should begin to notice when you're working in tax software that when you are making data entry in screens for self-employment, for farming, for rental properties, for K-1s flowing through from activities such as partnerships and S corporations, that somewhere in there should be a toggle or a button that you can click on to indicate whether or not you are at risk in the activity. And if you say you're not at risk, and I believe even on the Schedule C form itself, the IRS wants to know if you're at risk or partially at risk, that is going to trigger this particular topic, the 6198. Do I need to fill out Form 6198? And so we're going to begin by looking at what it means to be at risk, because you must be at risk and you have to apply the rules for at-risk activities before you then move on to a second set of rules that applies to passive activities. So we're beginning with at-risk. If you pass through all of the at-risk criteria so that you do determine you have a loss that you are at risk for, then you move on to the next set of rules, which is the passive activity loss rules, to see if they apply. So let's look at what it means to have amounts at risk. Amounts considered to be at risk include the amount of money you contributed to the activity, the adjusted basis of property you contributed to the activity, and amounts borrowed by you and then contributed to the activity. With respect to amounts borrowed, to be considered at risk for an amount you borrowed, you must be personally liable for the loan, and you must have to be the one who has to repay the loan, or you must have offered property as collateral for the loan. If you offered property as collateral, you are at risk for the fair market value of your interest in that property. Property offered as collateral for a loan cannot also be used in the activity directly. Amounts not at risk. You are not considered to be at risk in an activity to the extent you use non-recourse loans to finance the property, but there is an exception for qualified non-recourse financing. If amounts contributed or pledged to the activity are protected against stop-loss agreements, guarantees, etc., or for amounts borrowed for use in the activity that come from a person who is not a creditor but holds an interest in the activity. You should note that a shareholder's interest in a corporation is not an interest in an activity of the corporation under this rule. So essentially, under item number 2, if you are going to buy into a partnership, you can only be considered at risk for the amounts you actually physically pay to get into that partnership. If another partner in that partnership agrees to loan you money to buy into that partnership, then you're not considered to be at risk and you can't treat yourself as such. Qualified recourse financing, though. Qualified recourse financing is financing for which no one is personally liable for repayment of the debt and is borrowed by you to hold real property, secured by real property used in the activity, and not convertible from debt obligation to ownership interest, and is an amount loaned or guaranteed by a federal, state, or local government, or borrowed by you from a qualified person. And a qualified person is a person who actively and regularly engages in the business of lending money, such as a bank or savings and loan association. But a qualified person cannot be related to you, the seller of the property, or related to the seller of the property, or a person who receives a fee due to your investment in the real property. Adjustments to at-risk basis. The following adjustment items will affect your at-risk basis. Your basis increases if you contributed additional cash or property to the activity, you assumed additional qualified liabilities, or you received a share of taxable or non-taxable income from a pass-through entity such as a partnership or S corporation. Profits of pass-through entities are passed through to partners and shareholders on Schedule K1, and your share of income from these activities will add to your basis. Or you guarantee a loan for a partnership in which you hold an interest. You should note that a partner who guarantees a loan taken out by a partnership will increase the at-risk amount that they have in the partnership. However, this rule applies only to a partnership interest and not at all to S corporations. IRS rules specifically state that shareholders who guarantee loans taken out by an S corporation do not increase their at-risk amounts in the corporation. So there's a couple of important things going on here. Firstly, the rules for partnerships are a little less strict here. If you are in a partnership and the partnership takes out a loan and you co-sign on that loan, your basis in the partnership will go up by the amount of that loan. But if you are a shareholder in a corporation, an S corporation, and that S corporation borrows money on which you co-sign, you are not considered to be at risk for the amount that the S corporation has borrowed. And those are just two rules that may or may not make sense to you, but they are what they are. Let's look at an example for additions to basis. Rett purchased a rental property for $150,000. He made a $50,000 down payment and used qualified non-recourse financing for the remainder $100,000 of the purchase price. Rett also has a second mortgage on the rental property in the amount of $10,000, which he used to put new siding on the property. Rett's at-risk basis in the property is therefore $160. Let's look now at how flow-through income from an S corporation can add to your basis. Rett is a 30% shareholder in the S corporation Terra Inc. His 2013 year-end basis in the corporation was $20,000. In 2014, he received a K-1 reporting income of $10,000. Rett took no distributions from the corporation during the year, and therefore his at-risk amount at the end of the year is $30,000. So, looking at what causes your basis to increase. If you have ownership in a partnership or an S corporation, your basis increases when that corporation or partnership turns a profit and retains the cash. Whatever amount of profit that it has flows through to the partner or the shareholder, who then includes that as income on their return. And to the extent they've included income on their return but not received cash out of the partnership or the S corporation, their basis has gone up. Let's look at what would cause basis in a partnership or an S corporation go down. Your basis decreases if you received a distribution of cash or property from the activity, or you were relieved of a liability relating to the activity, or a recourse debt relating to the activity was converted to a non-recourse debt. Or you shared in losses flowing through to you from your ownership interest in a pass-through entity such as a partnership or S corporation. And here is an illustration of how relief of liability can decrease basis. Rett owns a rental property with a basis of $160,000, which is figured as follows. He had a cash down payment of $50,000. He had qualified non-recourse first mortgage financing of $100,000 and qualified non-recourse second mortgage financing of $10,000. So the total amount he has at risk is $160,000. But due to a decline in the housing market, the bank holding the second mortgage decided to cancel $2,000 of the outstanding $10,000 mortgage. This reduces Rett's year-end at-risk amount in the rental property to $158,000. And let's look at another illustration. This time, we have a distribution coming in from an S corporation that reduces basis. We're going to assume the same facts as earlier regarding Rett's ownership in the S corporation Terra Inc., except that during the year he took a $5,000 profit-sharing distribution from the corporation and figure his year-end at-risk amount as follows. We take the 2013 year-end basis of $20,000. We have K-1 income for the year of $10,000. That increases his basis up to that $30,000 mark. But then he also takes a profit-sharing distribution of $5,000, and that reduces his basis down to $25,000. There is a recapture rule because your at-risk basis cannot be less than 0. If your at-risk amount in an activity is less than 0, you may be required to recapture previously allowed losses, and the recapture amount is the lesser of the negative at-risk amount or the total amount of losses you deducted in earlier years minus any amounts that you previously recaptured. Activities that are covered by the at-risk rules. You are subject to the at-risk rules if you were involved in any of the following activities as a trade or business for the production of income: holding, producing, or distributing motion picture films or videotapes, farming, leasing Section 1245 property, exploring or exploiting oil and gas, exploring for or exploiting geothermal deposits, or any other activity not included in 1 through 5 that is carried on as a trade or business for the production of income. Examples of other activities carried on as a trade or business for the production of income include ownership of a sole proprietor business filing Schedule C, ownership of an interest in a partnership activity that owns a rental property, or ownership interest in an S corporation. Form 6198, at-risk limitations. Form 6198 is the form that you use as an individual, an estate, a trust, and also closely held C corporations. This form is used to tell the IRS that you are less than 100% at risk in a particular business activity. You use it to figure out what your at-risk amount is and what the amount of loss, if any, you are going to be allowed to claim for the year is. You must file Form 6198 if you are a partnership or S corporation and you have an interest in this entity that you then incurred a loss from the entity and you want to claim that amount, but you're not fully at risk for it. You're going to use Part 1 of the form to figure your current year profit loss from an at-risk activity. In Part 2 or 3, you figure the amount that you have at risk for the year. And then in Part 4, you figure your allowable deductible loss for the year. So let's take a look at the form together. And we have Part 1 where you figure your current year profit or loss from the activity. You use Part 1 to report the current year profit or loss from an activity and to report losses or deductions from earlier years that you could not deduct because the at-risk rules limited or did not allow you to claim the loss. You can see it begins on line 1 saying, what is the ordinary income from the activity? Then it asks for any gain from the sale or other disposition of assets that were used in the activity. What is the amount from Schedule D? What is the amount from 4797? So those would be the two forms used in most cases to report gain on the sale of assets. And number 3, on line 3, you would enter other income and gains from the activity that are coming from a Schedule K1, a Form 1065, or a Form 1120S. On line 4, you enter other deductions and losses that you incurred in the activity, including investment interest expense that was allowed on Form 4952. And then finally, on line 9, you enter your current year profit or loss from the activity, and then you move on to Part 2. You're going to use Part 2 if you know what your adjusted basis in the partnership or S corporation activity is, and you use Part 3 for a more detailed computation of your at-risk amount. Part 3 is a longer method of figuring your risk, and it may allow a larger amount to be at risk than if you just did Part 2. But if you do Part 3, you do not also do Part 2. It's either Part 2 or Part 3, but not both. And then you move down into Part 4 to figure your potentially deductible loss, because remember, after we figure the deductible loss, we still have to apply the passive loss activity rules next. But on line 20, you enter the amount that you have at risk, and on line 21, you enter the deductible loss. So here is an illustration of how we would go about doing these computations. Matt Dillon owns 50% of the S corporation Gunsmoke Inc., in which he is an active participant. Max basis in Gunsmoke Inc. at the beginning of the year was $20,000, and during the year he contributed another $15,000 to the corporation. Matt is also a guarantor for a $100,000 loan to Gunsmoke Inc., and currently has a loan for that $100,000 from First County Bank. Matt's K1 from the Gunsmoke Inc. is shown below. Prepare his Form 6198. So this is a pretty straightforward K1. I've got one line on it showing a loss of $50,000 for the year. Most of the time, of course, K1s have all kinds of numbers on them all over the place, but in this case, we just kept it simple. He lost $50,000, or his share of the loss from Gunsmoke Inc. is $50,000. So from that, we're going to figure his allowable loss. And the first rule is that his allowable loss from Gunsmoke cannot exceed his basis. And even though he's a guarantor of the loan that Gunsmoke Inc. has with First County Bank, IRS rules state that Matt is not at risk for that loan directly, and therefore he cannot increase his basis in Gunsmoke by the amount that he is guaranteeing. Matt cannot claim a larger loss on his Form 1040 than the amount he is at risk for, and his loss on Form 6198 is going to be limited to the amount he has invested. So the loss from Gunsmoke is $50,000. We begin by entering that on line 1. There are no gains being reported. There is no other income from the activity. He has no other deductions from the activity. We're done at $50,000. We then go into part 2 and 4 of the form. And on line 6, we enter his beginning basis on the first day of the year, which was $20,000. During the year, he fed some money into the company. $15,000 was the amount he put into the company during the year to keep it running. And so we're going to add that contribution during the year to the amount that he started the year with, and that gives him a $35,000 at-risk amount in the company. So then we move on and say how much is he allowed to claim, and obviously he's allowed to claim the amount he is at risk for, which is $35,000. So $35,000 is going to carry over as a deductible amount, but he's first going to have to then look to see if he's in a passive activity or a non-passive activity. If this is a non-passive activity, then it will carry over and be entered on Schedule E, page 2, and then from there it will move to line 17 of the Form 1040. In this case, we are saying it is a non-passive activity. On line 28 of Schedule E, page 2, which is where we are now, we're going to enter a description for the entity, which is Gunsmoke Inc., and we're going to describe that entity as an S corporation by putting a code S in line 28B. We enter the EIN of the S corporation, and then we've checked the box which says check if an amount is not at risk. We then, on line 28AH, enter the allowable non-passive loss, which is $35,000. And finally, we move down to line 41 where we enter the total allowed loss for the year, which is $35,000. Because this is a non-passive activity, we're not going to worry about any of the passive activity rules. They simply don't apply. And we're then going to move down to Form 1040 and carry that allowable loss to line 17. So that is the nutshell on the at-risk rules, and we're going to be moving on to the passive activity loss limits now. I wanted to talk a little bit about what to watch out for with these at-risk rules, because it's pretty simple to not really engage the thinking processes too much when you're interviewing a client and preparing their tax return. And I say this just because I've observed it over the years with preparers that I supervise, that there is this triggered response. If you get a K1 from a client, and let's go back up to Matt Dillon's K1. Client comes in with this nice K1 showing this big fat loss. There's a natural reaction to enter the K1 onto the tax return like you would enter a W-2 without much thought beyond that. If you're not thinking, that's when you can make a crucial mistake. And I'll give you an example of a conversation I had with a client a number of years ago. He came to me and he had a K1 that looked something like this one. And I said, well, what's this? And he said, oh, this is a business that I've been given a piece of a number of years ago. It's creating some nice deductions for me every year. I kind of like what I'm getting from it, but it's not really anything I have much to do with. And I said, well, what do you mean? And he said, well, a buddy of mine, he started it up a number of years ago. I agreed to help him out here and there, but I haven't really had much involvement. He still kept me on as this 30% owner, but I really don't do anything. And I said, well, did you help contribute any of the money to get it going? And the answer was, no, I've done nothing at all. So we have a situation with that particular client where not only was he not at risk, he was also passive in the activity. No loss was an amount that he could claim. He couldn't claim it under the at-risk rules because he had no money to lose. It was all his friend's money that was being lost. And he had no active involvement in the business either, so his passive nature also prevented him from claiming the losses. And yet for a number of years, his tax preparer had been allowing him these big losses and giving him refunds on them. So the whole thing, you could say, was a mess, but not an unexpected one, because if a preparer doesn't understand what these at-risk rules mean, and if the client doesn't understand what the at-risk rules mean, it can be a pretty simple thing to just go into the computer software and enter in the K1. The computer is going to allow the deduction, and who's going to know otherwise whether or not it's allowed? So you should be on the lookout for asking questions about what your basis is, tracking your basis, and entering the information related to that. Now, Drake Software a number of years ago started to introduce a whole bunch of at-risk basis worksheets that are in the background working on when you're entering information coming over from K1s. And it throws up notes and error messages at you if you've not done entries in there to indicate the amount that the person is at risk for. So there is some effort on the part of that particular software company to alert people to the fact that a person may not have a deductible loss, but there still has to be a correlation or a comprehension of how would I even determine what that at-risk amount is. And once you have determined that you are at risk for the loan, then it's time to move on to the passive activity loss limits, and that's where we're going to be spending quite a bit more of our time today. There's a lot more to learn with passive activity loss rules than there is with at-risk rules. Figuring out what you're at risk for is kind of elementary. So let's move on and talk about the passive activity loss rules now. A taxpayer materially participates in an activity if he works on a regular, continuous, and substantial basis in operations. If a taxpayer does not materially participate in an activity, then the losses are considered to be passive, which means they are generally not deductible in the absence of passive income. Material participation is time sensitive. A taxpayer materially participates in an activity only if he or she meets any one of the 7 material participation tests. Trade or business is an activity that involves the conduct of a trade or business, is conducted in anticipation of starting a trade or business, or involves research and development expenditures that would be deductible under Internal Revenue Code Section 174. Now, as far as the IRS is concerned, there are really only 2 business activities that are exempted from the passive loss rules. These include working interests in oil and gas activities and traders in stocks and bonds. Now, participation in a sole proprietorship, S corporation, or partnership activity can be active or passive. However, rental real estate activities are generally considered to be passive activities. If an activity is passive, the amount of loss you can deduct is limited. And generally, you can only deduct passive activity losses to the extent that you have income from other passive activities. So let's look a little bit at a historical perspective on this, because I like history a bit. Prior to 1986, a taxpayer could generally deduct losses in full from rental activities and trades or businesses regardless of his or her level of participation. And this gave rise to significant numbers of tax shelters. Many of them were abusive, and they allowed taxpayers to deduct non-economic losses against wage and investment income, thereby reducing or eliminating any tax they had. The Tax Reform Act of 1986 added Internal Revenue Code Section 469, and Section 469 limits a taxpayer's ability to deduct losses from businesses in which he or she does not materially participate, as well as rental activities. So this is a pretty significant event. Back in 1986, the rule books were rewritten, and a lot of things changed. And one of the things I have read a little bit about, mainly because it just interests me because I'm a horse person, is what ultimately happened in the horse industry. The horse industry is kind of a glamour type industry a lot of the time. You've got people who are involved in the racehorse side of things, and you have people involved in the breeding side of things with various levels of purebred horse. I'm particularly interested in the Arabian horse side of things because I have Arabians. They're my favorite. But there was a period of time where top stallions in the United States were selling for millions of dollars. And it wasn't because they were running races and winning big purses like was in the thoroughbred industry. It was because of just all the rah-rah hype about these horses. And they actually would have these horse shows where people would be invited that had deep pockets. And it would be a privilege to be invited to join these groups. And people would go into these collective groups, or syndicates they were called, to own a small piece of a horse. And it's done in the racehorse industry as well. There was one horse named Padron who sold at auction for $11 million, which is far more than would be reasonable for even the highest quality Arabian horse. And the entire industry was in a way a lot like a pyramid scheme, where people just kept hyping and hyping on top of getting these horses, and you know, the people at the bottom were coming in with money and keeping the whole thing going. But as a result of the Tax Reform Act of 1986, things in the industry changed remarkably. The number of horses being bred dropped, the value of horses dropped. The industry is very much different today, and a lot of people are grateful for it because there was just overbreeding going on. But what happened was people who were making these investments in these horses could just claim all these losses on their tax returns, and it was being allowed. And the law targeted far more than just these horse people. You know, it was all different types of business activities, and probably some were a lot more abusive than the horse industry. But it just brings to mind what people were doing and how they were able to take these financial write-offs against their other income on the back of the taxpayer. And so these rules have really been created to stop people from taking advantage. You can still invest in a horse, but you're not going to be able to take a deduction if you lose money, and it's determined that your investment in that horse activity is passive. So let's now look at real estate professionals. Because beginning in 1994, there was a relief provision relating to real estate professionals that was enacted for taxpayers who are treated as real estate professionals or able to meet the definition of real estate professionals by spending most of their time in real property trades or businesses. And this particular provision allows certain taxpayers to deduct current losses from rental real estate activities in full without any passive loss limitation. So let's take a look at the scope of the passive activity rules. Passive activity loss rules are generally applied at the individual level, although Internal Revenue Code Section 469 was enacted to discourage abuse of tax shelters. Ultimately, its impact extends far beyond shelters to virtually every business or rental activity, whether it is reported on Schedule C, F, or E, as well as to flow-through income from partnerships, S corporations, and trusts. Generally, the law does not apply to regular C corporations, although it does have a limited application to closely held C corporations. Now, the paragraph I've just read you above references an Internal Revenue Code section, and a link to IRC, this particular code section, is included here for your convenience. It's for your reading pleasure if you want to read it all for yourself. Categories of income and loss. The IRS divides all income into two categories: passive, which includes rentals and businesses without material participation, and non-passive income, which is essentially everything else. Businesses in which the taxpayer materially participates are non-passive, but so are salaries, guaranteed payments, 1099 miscellaneous commissions, income and portfolio or investment income. They're all deemed to be non-passive. So in the lingo of the IRS, we have portfolio income, we have investment income, and investment income typically includes interest and ordinary dividends, and then you've got portfolio, which can also include capital gains, and then you have earned income, which comes from your labors, and then you have unearned income, which can include things that are not from labor. And then separate from all of that, you can take all of those different types of income and then recategorize them one more time. And under that recategorization, you've either got passive or non-passive. And the reason we care about non-passive versus passive is that passive losses are only allowed to the extent you have passive income. So what is passive income? Well, passive income is income generated by a passive activity in the ordinary course of business. There are two kinds of passive activities: rentals, including both equipment and rental real estate, regardless of the level of participation, and businesses in which the taxpayer does not materially participate on a regular, continuous, and substantial basis. Examples include equipment leasing, a sole proprietorship or a farm on which the taxpayer does not materially participate, that is, does not regularly work the farm or the sole proprietorship themselves, limited partnership interest with some exceptions, and partnership, S corporation, and limited liability company businesses in which the taxpayer does not materially participate. So what is a non-passive activity? Well, everything else is non-passive. Income and losses from the following activities are generally considered to be non-passive: salaries, wages, and 1099 miscellaneous commission income, guaranteed payments, royalties derived in the ordinary course of business, a sole proprietorship or farm in which the taxpayer materially participates, partnerships, S corporations, and limited liability companies in which the taxpayer materially participates, trusts in which a fiduciary materially participates, pension or annuity income, and finally lotto or gambling winnings. And we could even keep going on with this list with other types of income. Essentially, anything that is a business activity in which you do not materially participate is considered to be non-passive. Portfolio income is also non-passive income, and portfolio or investment income is income typically reported on Schedule B or D and includes interest and dividends as well as capital gains and losses, including gains or losses from stocks and bonds and the sale of undeveloped land or other investment property. So how do these passive activity loss limitations work? Well, generally, losses generated by a passive activity can only be used to offset income generated by other passive activities. There is an exception to this rule when there is a disposition of a taxpayer's entire interest in a passive activity. Losses from passive activities cannot offset non-passive income from wages or salaries, portfolio or investment income, or profits from income of sole proprietors, farms, partnerships, S corporations, or any other activity in which the taxpayer materially participates. In other words, a taxpayer cannot deduct losses from passive business activities and rentals unless he or she reports other forms of passive income on the tax return against which those passive losses can be offset. And here is an example of what I mean, where we have a loss from a passive activity which is limited. Luke is a 40% owner of Yemen Inc., which is an S corporation. The daily business activities of the corporation are carried out by employees of the corporation and by other shareholders. Luke's participation is limited to the money he has invested in the corporation. During the year, Yemen Inc. incurred a $25,000 operating loss, and Luke's distributive share of that loss is $10,000. Luke will not be able to claim the loss on his personal return unless he has net passive income from another passive business or rental activity. If Luke has no other passive activity income, he will need to carry his loss on Yemen Inc. forward each year until he either has passive activity income or disposes of his entire interest in Yemen Inc. So, of course, we're assuming that Luke is at risk, that the money that this company lost was his money that he invested. He has to be at risk. So we've established, before we even get to this point, that he is at risk. And his share of the overall loss from Yemen Inc. is $10,000, and even though he's at risk for that $10,000, he's not allowed to deduct it unless he can show he has another form of passive activity income to offset it. We also have to be worried about passive activity credits. You can subtract passive activity credits only from the tax on net passive income. Passive activity credits include the general business credits, and credits that are more than the tax on income from a passive activity are then carried forward. So let's stop and think about what this is saying. You have an ownership interest in an S corporation, and that S corporation has made an investment into an expense that qualifies for a credit. Let's suppose you are a 10% shareholder in an S corporation that runs a restaurant. It's a pretty big going concern. You are a minor investor at 10%, and that's your only interest. You don't show up at the work, you don't bus tables, you don't cook, you're just an investor in that business, and you get your K-1 showing what your distributive share of the loss is in a particular year. Because you are considered to be passive, that loss, whatever it is not allowed. Now let's suppose that because this is a restaurant activity, there is a credit being claimed on that S corporation return that flows through to you for the tax on tips. There's a credit for employer tax on tips. It's a pretty nice credit. It refers to the tip income that an employee has and the payroll share of payroll tax on that. It can come back as a credit. That credit is showing up on your K-1, and because you are passive in the activity, you cannot claim that loss unless you are at risk in the activity and also not passive in the activity. So we could just flip things around a little, say, and instead of showing a $10,000 loss on the K-1 from this restaurant activity, you actually show a $10,000 profit share on your interest in this activity, and you also show that your share of the credit for tax on tips is $1,000. Are you going to be able to claim that credit of $1,000 as your share of tax on tips when you are passive in the entity? And that means you're going to have to do a calculation to see what your tax is on the $10,000 of profit. You're going to have to determine if the tax is at least $1,000 on your personal return, because it must be in order for you to take full advantage of that credit for tax on tips, because that credit is associated with your passive activity and can only be used to offset tax assessed on the income from that passive activity. There is an exception for active participation in rental real estate activities. You may be able to deduct up to $25,000 of loss on your rental real estate if you actively participate in managing your rental real estate. Active participation is a lower standard of involvement than material participation. If you meet the active participation test, you can deduct up to $25,000, or half that amount if you are married filing separate but did not live with your spouse at any time during the year. And you can do so as long as your rental real estate losses are associated with a tax return on which the adjusted gross income of the filer is less than $150,000. If the income is over $100,000 but less than $150,000, there is a phase out of the amount of the loss deduction that you can claim. So the amount of your allowable passive activity loss for your rental real estate is reduced and gradually eliminated when your modified AGI is between $10,000 and $150,000. The most that you are allowed to deduct as a loss is $25,000. You might be allowed to deduct nothing. You might be allowed to deduct somewhere in between 0 and $25,000, depending on how high your income is and how big the loss is. But if your filing status is married filing separate and you lived with your spouse, then your allowable loss is 0. So let's look at what would be included in modified AGI. We're looking at the phase-out range being between $100,000 and $150,000 of adjusted gross income, and it's modified AGI that we're looking at. So what does modified AGI mean? Well, for purposes of the passive activity loss limit on rental real estate activities, your modified AGI is the AGI shown on line 38 of your 1040, but figured without taking into account any passive income or loss or any loss allowable by reason of the exception for real estate professionals, taxable Social Security or Tier 1 railroad retirement benefits, deductible contributions to an IRA or certain other qualified retirement plans, the deduction for employer equivalent portion of self-employment tax, the deduction allowed for student loan interest or tuition and fees, the exclusion allowed for employer-provided adoption benefits, and the exclusion allowed for qualified U.S. savings bond interest that was used to pay for higher education expenses, the deduction for the domestic activities production deduction, as well as any overall loss from a publicly traded partnership or PTP. Active participation, what does that mean? Because in order to claim any loss at all on your rental property, unless you have passive activity income, you're going to have to show that you were an active participant in the rental activity operation. As an active participant, both of the following rules apply. Number one, you and your spouse owned at least 10% of the rental property, and you made management decisions in a significant and bona fide sense. Management decisions include approving new tenants, deciding on rental terms, approving expenditures, and similar decisions. And here is an example where we have a loss that is partially deductible due to active participation. Red Buttons is a single filer and is not a real estate professional. His 2014 W-2 shows that he earned $120,000 in wages, and his Schedule E is attached and shows he has a $27,917 rental loss from an apartment building that he owns. Red actively participates in the management of the apartment building. His modified adjusted gross income is $120,000, so his passive activity loss will be limited. Figure Rett's allowed loss of $15,000 and the $12,917 carryover to 2015 as shown next. So we go over to his 1040 form, and we're essentially showing to begin with that his income from wages is $120,000. And I'm going to tell you that his allowable loss is $15,000, but let's just think a little bit about how we get there. The phase-out range for claiming a deduction for losses on rental real estate is between $100,000 and $150,000. That means we have a $50,000 phase-out range. If his income is $120,000, it means he is $20,000 into a $50,000 phase-out range, or you could compute the math on that and say $20,000 divided by $50,000 is 40%. He's 40% into the phase-out range, which means he is allowed up to 60% of the maximum allowed loss deduction. If the maximum loss allowed is $25,000, 60% of that number is $15,000, and $15,000 then becomes his allowable loss deduction. So I'm going to throw in a Schedule E for you to take a look at. In this case, we have a property which has generated $101,500 of income. It's got $129,417 of expense, leaving him with a loss of $27,917. But the amount that he's allowed to deduct is $15,000. And we move on to then fill out Form 8582, where we're going to show that loss being entered on line 1B. It says activities with a net loss, enter the amount from worksheet 1, column B, and I'll show you that in just a second. And so we figure that the loss is $27,917. We carry that number down to line 4, and then in part 2 of the form there is a computation, special allowance for rental real estate activities with active participation. You will see that rental real estate activities with active participation is recorded up here. And then we have other passive activities down here on line 3. So we're actually working in line 1 of the form, which then allows us to move down and complete part 2 of the form, where we begin by entering the smaller of the loss on line 1D, or the loss showing up on line 4. And then we enter $150,000 because this is the top end of the phase-out spectrum. We then enter the modified AGI of the filer, but not less than 0. In this case, it's $120,000. And that gives us a $30,000 difference. And it essentially shows that we're allowed 60% of the deduction, and the math takes us there, $15,000. Here is one of the worksheets provided on Form 8582. Worksheet number 6 is just again showing a description of the activity, which is the apartment building, the loss, the unallowed loss, and the allowed loss. And this, of course, unallowed loss in column B is going to carry forward to next year. Now, this actually does bring to point something that's rather important to be on the lookout for when you get a new client. When you get a new client and they come to you to do this year's tax return, it should be a matter of course thing that you ask to see last year's tax return and probably the tax return from the year before as well. I typically like to go back at least 2 years. And the reason I want to see the earlier year returns is I want to see what was done on them, but I'm also really on the lookout for things like this worksheet that's showing an unallowed loss, because my client is probably not aware of this number. And without a copy of the tax return, I would have no way of knowing that there's an unallowed loss carrying forward from an earlier year. So it's good to ask for those prior year returns for new clients, because you're looking for things like that would then become an opening number for the 2015 return. Let's talk now about the exception for real estate professionals. A real estate professional who owns and manages rental property is deemed to have non-passive income from that rental activity, and as such, the real estate professional meets the material participation rule, and his or her losses on rental activities are not limited by the rules relating to passive activity losses. For any portion of the year that you were a real estate professional, your losses from active management of your real estate are not passive activity losses. So who qualifies as a real estate professional? Well, there's a couple of rules that are pretty darn important, and you have to pay attention to both. To qualify as a real estate professional, both of the following requirements must be met. Number 1, more than half of the personal services performed during the year in all trades or businesses for the year were performed in real property trades or businesses in which you materially participated, and you performed more than 750 hours of services during the year in real property trades or businesses in which you materially participated. This is a rule that a few people catch on to. I mean, if you are a real estate professional, you are allowed to deduct your losses without regard to the passive activity loss limits and without regard to that $25,000 limit rule. Now, I just want to tell you a cute story that came through our office a couple of years ago. We had a client who gets big W-2s out of Intel. I like to talk about Intel because we have so many clients from there. So he's one of those people at Intel who's coming into our office with a $350,000 W-2. And he also owns a rental property. And he wanted to be able to claim this loss on his rental property, but clearly his income was far too high, well beyond that $150,000 top limit for the phase-out range. So he thought he could pull off becoming a real estate professional by getting a real estate license to sell real estate. We had to inform him that he still was out of luck, because he was going to have to show that he put in more than 750 hours of services during the year, but he also needed to show that more than half of the personal services performed during the year in all of the trades or businesses were performed in real estate activities. And if he's pulling off that kind of income from Intel, there is no way in heck that he's putting more than half his time into a real estate business. So he was just out of luck. But he certainly worked hard to try and get around that rule. We just wouldn't let him get away with it. Though that personal services performed as an employee do not count unless you own more than 5% of the employing company. So if you are working for a real estate company performing services for that company, you are not going to be considered to be a real estate professional unless you can show you owned more than 5% of the employing company. What is a real property trade or business? Your business is a real property trade or business if it does any of the following with real property. It develops or redevelops it, constructs or reconstructs it, acquires it, converts it, rents or leases it, operates or manages it, or brokers it. Real estate professional election to treat all interest as one activity. So you've established that you are a real estate professional, and now there's another rule that you can be concerned about. And this rule says that if you were a real estate professional, you can choose to treat multiple real estate interests as only one activity. You can make this choice for any year you qualify as a real estate professional. Once you make the choice, the following rules apply. Number 1, the choice is binding for the tax year that you make it and for any later year that you are a real estate professional. And number 2, the choice will continue to apply to years where you are not a real estate professional. However, for any year that you are not a real estate professional, the rental activity will be subjected to the passive activity loss limits. Grouping is important because if the activities are separate, you must show material participation in each one. But if the activities are grouped, you need to show participation only in all of the activities as a whole. So how do you make the election? Well, you need to attach a statement to the return. And the statement says, to make the election to combine activities, attach a statement with your original return that says, I elect Section 469C7A. The election must be properly made to be accepted by the IRS. Well, Drake Software actually has a screen that you go in to make elections. This is one of the elections there. You just put a check mark on it, and it attaches it to the return. I do remember working with a new client a few years ago. He was not a real estate professional, and each and every year he filed a return, this particular election was attached to the return over and over again. It was a little bit funny, and then not only did they attach the election, they didn't treat all of the properties as one property. They still had each one listed separately. So the idea behind this particular rule is that you could keep a single set of books for all of your real estate activities rather than having to list each one out separately. But the danger in doing that is that if you then turn around and sell one of those properties, you're not going to be able to realize that separate activity as having pulled out. So there are benefits and cons to making this particular election. Here is an illustration of how it works. Real estate professional owns and operates a residential rental apartment. His income from the activity was $100,000 and his expenses totaled $129,180 for the year, leaving him with a $29,180 loss. Since he is a real estate professional, his loss is not limited by his income, nor is his loss limited to $25,000. So here we have a Schedule E, this time for real estate professional. We've gone through and listed all of the income and expense amounts he has, and we get down to line 26 and we show he has a loss of $29,180, and that's going to carry over to Schedule E, page 2, and we're going to enter it on line 41 where we enter $29,180, and you can see that there is on line 42 a reconciliation of farming and fishing income, and then on line 43 there is a reconciliation for real estate professionals. If you are a real estate professional, see the instructions and then enter the net income or loss you reported anywhere on Form 1040 from all rental real estate activities in which you materially participated. So what is material participation? Well, generally, a passive activity is any rental activity or any business in which the taxpayer does not materially participate. By comparison, non-passive activities are businesses in which the taxpayer works on a regular, continuous, and substantial basis. In addition, passive income does not include salaries, portfolio, or investment income. A trade or business activity is not a passive activity if you materially participated in the activity, and the Internal Revenue Code defines material participation as the regular, continuous, and substantial participation by a taxpayer. Determining whether an activity is passive or non-passive is done on an activity-by-activity basis and at the 1040 level. A taxpayer is generally deemed to be materially participating if he or she works more than 500 hours a year in the activity or performs substantially all of the work in a business. If you materially participate in an activity, the activity is not passive and losses are not limited. But conversely, if a taxpayer works 500 hours or less during the year or does not perform most of the work, then the losses are not allowable unless he or she has passive income. Now, it stands to reason that if your business is selected for an audit, that one of the things that the auditor is going to be on the lookout for is to determine whether or not this is an activity that is passive or non-passive. And in fact, I have a really good recent example. I had a client come in to me, and he had been preparing his own tax return until he was selected for an audit and didn't do too well in the audit. And so he decided in the first year following that audit to find a tax professional, and he ended up in front of me. And what triggered his audit was the fact that he had decided to buy a yacht. He lived in Portland, Oregon, but his yacht was up in Seattle. And the idea was that he invested in this yacht, he kept it at a dock in the Seattle area, and there was a company that managed the yacht and rented it out. And he had claimed the income and expenses for this yacht on Schedule C. And he had a loss, he figured, and he claimed that loss, and that loss in turn triggered an IRS audit. One of the things that happens in IRS audits, and I've watched this over the years, is my clients sit down and they start talking. The auditor will ask a question, and they start talking. And they start saying things that they think the auditor wants to hear. And sometimes they answer the auditor's question directly. And in this case, the auditor asked, well, how many hours did you put into this activity during the year? And my client really had no idea how many hours he'd put into the activity. He didn't understand that this was a crucially important question. He just sat down. He was just getting with his auditor for a few minutes, and she asked one of the most important questions of the entire audit. He had no idea why he was being asked the question, wasn't on the defensive for it, wasn't prepared for it, and had no idea that it basically cost him a bunch of money, and he had to pay the IRS tax because of his answer. But his answer was something he just pulled out of his hat. He had no idea how many hours he'd put into that boat activity. He'd never tracked it. He'd never thought about it. He just decided to say 300 hours. I put 300 hours into the boat. And the auditor said, okay, and she wrote it down, went through the rest of the audit, asked for all of the receipts, got to the end, and even though he was able to justify all of his expenses, his loss was not allowed because she determined that he was passive in the activity. And so when I sat down with him, I said to him, well, the reason she disallowed your loss is because you did not demonstrate that you had more than 500 hours of active participation in this activity. There was a test, and you failed the test by saying 300 hours. And he said, well, I have no idea how many hours I worked. And I said, well, maybe you could sit down and think about it. You know each day that you probably went out there. I'm sure you have a memory of each trip that you went out. You have receipts to show when you were there and doing work on the boat. Figure out how many hours you really put into it. And so he went home and he did that. And later on he came back to me and he said, I put way more than 500 hours into that boat. It appeared that he did have something that would have met this particular test. It's just that the time and place where the question was asked, he had no idea why he was being asked the question or how to respond to the question, and he basically said the wrong thing. Clients do this all over the place in audits, I've noticed. That's just an example where they gave an answer to a question without understanding the purpose behind the question. But very often they just keep talking in hopes they're going to say something that benefits them and usually just gets them deeper into trouble. All right, let's talk about these material participation tests, because right now, in order to show that you are non-passive in an activity, you have to show that you are materially participating in the activity, and you are generally deemed to be participating materially if you spend more than 500 hours in the activity, or you are providing substantially all of the work in that particular activity. And in the case of my boat guy, he wasn't able to show that he was the only one involved in that activity, because there was obviously the leasing company up there that managed the boat, managed the rentals of the boat. So when customers came in, their staff collected the money, took the people out onto the boat, helped them get set up on the boat, and he wasn't involved in that part. There was someone else there. So he couldn't show he was doing all of the work. He needed to show, therefore, that he did at least 500 hours, and he wasn't able to do that. So let's look, though, at some other rules, because even if you fail this 500-hour test or this mostly performed all of the work test, you might still be deemed to be materially participating. And these rules come from IRS Publication 925 on pages 5 and 6. You are materially participating in a trade or business activity for a year if you satisfy any one of the following tests. Firstly, we have the more than 500 hours of participation test. You participated in the activity for more than 500 hours. Or test number 2, your participation was substantially all of the participation. You provided virtually all of the participation in the activity, and under this test, little or none of the participation can come from other owners of the activity or from employees of the activity. More than 100 hours and the majority of participation. You participated in the activity for more than 100 hours during the year, and you participated at least as much as any other individual, including individuals who did not own any interest in the activity for the year. Significant participation activity. If you have more than one activity and you meet this test if you participated in all activities for more than 500 hours during the year and you participated in each activity for more than 100 hours during the year. A significant participation activity is any trade or business activity in which you participated more than 100 hours during the year and in which you did not materially participate under any other material participation test. Also, test number 5, material participation in the activity for any 5 of the 10 immediately preceding tax years. You are treated as having materially participated in an activity for any fixed taxable year if you can show that there were 5 taxable years during any of the 10 immediately preceding taxable years where you were materially participating, and those years don't need to be consecutive. Number 6, the activity is a personal service activity for any 3 preceding tax years. You materially participated for any 3, whether or not they are consecutive, preceding tax years in a personal service activity, and an activity is a personal service activity if it involves the performance of personal services in the fields of health, including veterinary services, law, engineering, architecture, accounting, actuarial science, performing arts, consulting, or any other trade or business in which capital is not a material income-producing factor, such as tax preparer. So let's just suppose you've been running your tax preparation business for a number of years and the day comes where you decide to retire. You've got a good staff working for you. They're able to run the show pretty much without your presence, but you still own the business and you basically retire from the business. You might show up once in a while to shake hands, pat people on the back, sign a paycheck or two, but fundamentally you're spending as little time at work as you possibly can because after all you are retired. And IRS says because you were active in that business for at least 3 preceding years and it was and is a personal service business, then you are deemed to be active in it even though you're no longer active in it as long as you were active for at least 3 years. Test number 7, you participated in the activity on a regular, continuous, and substantial basis during the year. You did not materially participate in the activity under this test if you participated in the activity for 100 hours or less during the year. Your participation in managing the activity does not count in determining whether you materially participated under this test, though. If any person other than you received compensation for managing the activity or any individual spent more hours during the tax year managing the activity than you did, regardless of whether that individual was compensated for their management services. Participation, in general, any work you do in connection with an activity in which you own an interest is treated as participation in the activity. However, do not include work that is not usually performed by owners. You do not treat the work you do in connection with an activity as participation in the activity if both of the following are true. Number 1, the work is not work that is customarily done by the owner of that type of activity, and one of your main reasons for doing the work is to avoid the disallowance of any loss or credit from the activity under the passive activity rules. And I can see that we are at the top of the hour and due for a break, so let me give you a password. Password number 1 is Scotia, S-C-O-T-I-A. Scotia. All right, back from break, and I can see you changed your answer, James. You actually did go to the correct answer. The first one you had was wrong. But let's pull up the answer note that I have for it. And of course, the answer is B. And the reason it is B, I'll read through this question and then we'll go through it. C question. It's an at-risk question. If you're studying for the special enrollment exam to become an enrolled agent, this is the type of question you could expect IRS to be asking you to see if you understand the rules for at-risk, especially with the term non-recourse debt. Bill took out a $100,000 non-recourse loan and bought an apartment building. The building is not security for the loan. Bill spent $25,000 of his own money on repairs before he rented the apartment building to the public. He is single, works full-time, and earns $80,000 per year. Bill's loss from the rental real estate activity in which he actively participates is $30,000. He has no passive income. For what amount is Bill at risk, and how much of Bill's passive loss from his rental activity is deductible? Well, he's at risk for only the amount that he put in, which was $25,000. The $100,000 non-recourse loan does not add to his basis because he is not at risk for the loan. His income is fine. He earned less than $100,000, so his loss will not be limited by his income. It's only limited by his at-risk amount, and actually it would be limited as a rental real estate activity to $25,000 no matter what. So he's going to have a $5,000 carry forward for two reasons. He's not at risk for $5,000, and the limit per year is $25,000. So that makes B the correct answer. We can go and look at the answer that I have up here. You are not considered to be at risk for your share of any non-recourse loan used to finance an activity or to acquire property used in the activity unless the loan is secured by property not used in the activity. This means he is only at risk for the additional money he contributed. His passive loss is $25,000, and as he is an active participant in the rental property, he qualifies for the special allowance for passive losses, but he cannot deduct more losses than he is at risk for, and also he's limited to $25,000 no matter what. And you can look in references that we've shown here from IRS Publications 925 for more information. So before the break, we were talking about participation as an investor. And I was mentioning how IRS auditors are pretty much going to be on this topic pretty early on to determine if a business owner is considered to be materially participating in their business activity. And I wanted to take you briefly to the internet just to show you something because it's kind of interesting. All right, so this particular screen I'm on is actually IRS's website, and I did a search for the Audit Technique Guide on Passive Activity Losses. Audit technique guides are guides that auditors use when they are auditing a particular business or a particular taxpayer. And this audit technique guide is essentially telling the auditor the types of questions to ask to establish whether the passive activity loss rules apply and whether a person is considered to be materially participating in the activity. And you can see here that we've got rental losses in a nutshell. Then they're going to explore the $25,000 loss. They're going to look at whether or not they're dealing with a real estate professional and what the material participation rules are. It's got a variety of different references that auditor is directed towards. We then move on to passive income, and then on to material participation, where there's a whole bunch of guidance in here for an IRS auditor to determine whether or not there was material participation. So it doesn't hurt at all if you're questioning whether or not your client is materially participating to open up this audit guide and start going through the techniques yourself. So back to where we were talking about determining whether or not you are materially participating in an activity, even if you don't meet the 500-hour test or the most of the work test or substantially all of the work tests. There were a variety of different tests. And then we talked about work that was not usually performed by owners. And you are not deemed to be materially participating in an activity unless you are doing the type of work that would be normally done by a person who is running the business. And work that you do merely as an investor is not going to translate over and turn into material participation. So let's look at what they look at when they're describing participation as an investor. You do not treat the work you do in your capacity as an investor in an activity as participation unless you are directly involved in the day-to-day management or operations of the activity. Work you do as an investor includes studying and reviewing financial statements or reports on operations of the activity, preparing or compiling summaries or analyses of the finances or operations of the activity for your own use, and monitoring the finances or operations of the activity in a non-managerial capacity. Also, your spouse's participation is deemed to be your participation. Your participation in an activity includes your spouse's participation, and this applies even if your spouse did not own any interest in the activity and you or your spouse did not file a joint return for the year. So let's just suppose you own, I don't know, an ice cream shop. You're the sole owner of the ice cream shop, but you have no involvement in it. Your spouse does all of the work in the ice cream shop. Her participation in that ice cream shop is deemed to be your participation in that ice cream shop, and therefore you are considered to be materially participating in that ice cream shop. Grouping of activities. You can treat one or more trade or business activities or rental activities as a single activity if those activities form an appropriate economic unit for measuring gain or loss under the passive activity rules. Grouping is important for the following reasons. If you group two activities into one larger activity, you need only show material participation in the activity as a whole. And if two activities are separate, you must show material participation in each one. If you group two activities into one larger activity and you dispose of one of the two, then you have disposed only part of your interest in an activity. And if two activities are separate and you dispose of one of them, then you have disposed of your entire interest in the activity. So let's just think for a minute. Let's just suppose you are not a real estate professional and you own three different activities and you put them together and lump them as a single activity because it's an appropriate economic unit to do so. And then you manage to sell off one of the activities. Well, you're not going to be able to claim any losses directly relating to that sale if it is deemed that the entire activity is passive, because you would have to dispose of the entire activity in order to claim that loss. Grouping can be important in determining whether you meet the 10% ownership requirement for actively participating in rental real estate activities as well. Appropriate economic units. Generally, to determine if activities form an appropriate economic unit, you must consider all of the relevant facts and circumstances. You can use any reasonable method of applying the relevant facts and circumstances in grouping the activities. And there are 5 factors that have the greatest weight in determining whether activities form an appropriate economic unit. All of the factors do not have to apply to treat more than one activity as a single activity. Firstly, we look, is there a similarity, and what are the differences between the different types of trades or businesses? What is the extent of common control? What is the extent of common ownership? What is the geographical location of the activities? And finally, the interdependency between or among the activities, which may include the extent to which the activities either buy or sell goods between or among themselves, involve products or services that are generally provided together, have the same customers, have the same employees, or use a single set of books and records to account for the activities. And here is an example that IRS provides. John Jackson owns a bakery and a movie theater at a shopping mall in Baltimore and a bakery and a movie theater in Philadelphia. Based on all of the relevant facts and circumstances, there may be more than one reasonable method for grouping John's activities. For example, John may be able to group the movie theaters and the bakeries into one activity, a movie theater activity and a bakery activity, a Baltimore activity and a Philadelphia activity, or 4 separate activities. Well, let's look at the pros and cons of each. If you have only one activity, you only have to keep one set of books. That can be much simpler. On the other hand, if you're only keeping one set of books, it's going to be harder to identify how well each activity is doing. If you divide it into a movie theater activity and a baking activity, that would make sense because they really are unique in their nature, and you would be able to track how well your movie business is doing and how well your bakery business is doing. But it could be that you want to use the same set of people and staff to run each activity in both locations, and so you ultimately have a Baltimore activity and a Philadelphia activity and spread the books between those. And finally, you could say that the most precise way of tracking everything would be to have 4 separate activities. So any of those IRS says could be correct. You just need to decide which one is appropriate for you. There are, however, certain activities that may not be grouped. The following activities in general may not be grouped with any other activity or any other kind of business: holding, producing, or distributing motion picture films or videotapes, farming, leasing any Section 1245 property, exploring for or exploiting oil and gas resources, or exploring for or exploiting geothermal deposits. Back to rental activities. In general, a rental activity may not be grouped with a business activity unless it is owned in the same percentage as the business or it is insubstantial in relation to the business. However, you can group them together if the activities form an appropriate economic unit and the rental activity is insubstantial in relation to the trade or business activity, the trade or business activity is insubstantial in relation to the rental activity, or each owner of the trade or business activity has the same ownership interest in the rental activity, in which case the part of the rental activity that involves the rental of items or property for use in the trade or business activity may be grouped with the trade or business activity. So to make sense of that, IRS provides this particular illustration, which involves a rental and business activities that it deems form a single economic unit. Herbert and Wilma are married and are filing a joint return. Herbert is the sole shareholder in Healthy Food, which is an S corporation, and it operates a grocery store business. Wilma is the sole shareholder of Plum Tower, an S corporation which owns and rents out a commercial building. Plum Tower rents out part of its building to Healthy Food. Plum Tower's grocery store rental business and Healthy Food's grocery business are not insubstantial in relation to each other. Herbert and Wilma file a joint return, so they are treated as one taxpayer for purposes of the passive activity rules. The same owner, Herbert and Wilma, owns both Healthy Food and Plum Tower with the same ownership interest, which is 100% in each. If the grouping forms an appropriate economic unit, as discussed earlier, Herbert and Wilma can group Plum Tower's grocery store rental and Healthy Foods grocery business into a single trade or business activity. And ultimately, that would mean that the passive activity loss limit would not apply to the Plum Tower rental going back and forth there. Grouping of real and personal property rentals. In general, you cannot treat an activity involving the rental of real property and an activity involving the rental of personal property into a single activity. However, you can treat them as a single activity if you provide the personal property in connection with the real property or the real property in connection with the personal property. And sale of a passive activity. You may generally deduct any prior year's suspended losses and current year passive activity losses if you dispose of your interest in the activity during the year. This rule applies if you dispose of your entire interest in the activity and you do not make the sale to a related party. And here is an illustration where you have a sale of interest in a passive activity. Donald Duck disposed of his entire interest in Daisy LLC in a sale to an unrelated party. Donald is a passive partner in the business and has $13,000 of prior year suspended losses. His current year passive income is $5,000. Donald has no other passive activity income or loss for the year, and since he has disposed of his entire interest in Daisy LLC, he will be allowed to claim any outstanding losses after reducing these losses by current year income. Subtract current year income of $5,000 from the prior year loss carry forward of $13,000, and the resulting loss of $8,000 will be allowed in full in the year of sale. He will enter it on Schedule E, page 2, and then carry it to Form 1040, line 17. Schedule E, page 2 is shown next. So we begin on Schedule E, page 2 by describing the business activity, which is Daisy LLC. We enter P for partnership. And remember that he has a prior year suspended loss of $13,000 and a current year profit of $5,000. We're going to offset the $5,000 profit by the loss, and then normally he would carry forward $8,000. But because he has a complete disposition of this activity in the year of sale, he is going to enter the loss. And even though it's still a passive loss, it's treated as if it were non-passive in terms of being allowed. So he enters the amount and then carries it to Form 1040. You can see we pull it down to line 41 and then carry it over and enter it on line 17 of his Form 1040. Dispositions other than by sale. If you dispose of your property other than by sale, there are additional rules that apply as follows. Firstly, inheritance. Suspended losses are reduced by step-up basis, and excess losses are claimed on the final return of the decedent. With a like-kind exchange, your suspended losses remain suspended losses on the new property that you acquire. However, suspended losses do become deductible to the extent of any taxable boot you receive from the exchange. For installment sales, suspended losses are deductible each year that gain is realized. And for a sale to related party, your suspended losses remain suspended until such time as the related party sells to an unrelated party or you have any other form of passive income. In divorce, if you transfer property in a divorce, your suspended passive losses that are associated with that activity are transferred to your spouse. Your spouse who received the property will add the suspended losses to his or her basis. For passive activity changes, there's a final bullet point here for a passive activity that changes to a non-passive activity. Because remember, on a year-to-year basis, you're going to be looking at that 500-hour rule. And it could be that in year 1 you meet the 500-hour rule and in year 2 you don't. And you also cannot show that you were active at least 3 years in a service entity, or you were active for at least 5 years in another form of business activity. And you've basically flipped from being passive to non-passive or non-passive to passive. That's what this is about. If you become active in an activity where you were previously passive, then your prior year suspended losses remain passive losses. Suspended losses may be claimed to the extent of income produced from the activity plus income from all other passive activities. Unallowed passive activity credits. Prior unallowed passive activity credits cannot be claimed when you dispose of your entire interest in a passive activity. However, the amount of unallowed credit can be used to determine your gain or loss upon disposition of the activity. You can elect to increase your basis in a passive activity by the amount of original basis reduction that is attributable to the unallowed credit to the extent that the credit was not allowed because of the passive activity limits. You cannot elect to adjust the basis for a partial disposition of your interest in a passive activity. Refer to the instructions for Form 8582 credit for more information. And here is an example where we have an unallowed passive activity credit that is added to the basis in property. Richard Boone disposed of his entire interest in the passive activity Paladin LLC. He has a prior unallowed disabled access credit in the amount of $2,000. He's not going to be allowed to claim a $2,000 credit when he sells, but what he can do is increase his basis in Paladin LLC by that $2,000, and it would reduce his gain on the sale or increase his loss, whichever it is. This class, we haven't really touched on publicly traded partnerships at all, and that's because they are rather a unique animal, and I discussed them just last week in another class on the sale of business assets. And PTPs are an awkward animal because they're really, if you're invested in a publicly traded partnership, you're hardly going to say that you're active in it. To the contrary, it's going to be a passive activity. But when you are looking at the income and losses flowing through from partnership activities, these publicly traded partnerships, it's very often the case that you're dealing with the sale of business assets, and you have to fill out a Form 4797. So that's where I included, or why I included, publicly traded partnership sales on my course on sale of business assets. But there's also an appropriate point to talk about it here when we're talking about passive activity loss limits, because when we get into publicly traded partnerships, there's one more level we have to look at. With most passive activity losses, you merely need to show that you have some form of passive activity income, and they can offset each other. So let's just suppose you have a rental real estate loss that you are passive in, and that you're also a passive shareholder in a restaurant, say, and you have a year where the restaurant's showing a nice little profit. The loss you have on the rental property can offset the passive profit on this restaurant activity. They're really completely unrelated in any way except they're both passive. But with publicly traded partnerships, you can't do that. A publicly traded partnership loss cannot be offset by other passive activity income. The only way you can offset a publicly traded partnership loss is from profits of that exact same publicly traded partnership. And the only exception to that is when you sell. If you finally sell a PTP at a loss, you're allowed to realize current year and prior year losses in the year you have a complete disposition of that particular investment. A PTP is a partnership whose interests are traded on established securities markets or are readily tradable on a secondary market or its substantial equivalent. Section 469K provides that the passive activity limitations must be applied separately to items of each PTP. Passive activity losses from a PTP generally may be used only to offset income or gain from passive activities of the same PTP. There are some basic rules for claiming losses on PTPs, and I do have a real detailed illustration of how these work in the class I talked last week on sale of business assets. But in a nutshell, these are the rules that you have to apply. Do not report passive income gains or losses from a PTP on Form 8582. Instead, use the following rules to figure and report your income gains and losses from passive activities that you held through each PTP you owned during the year. You combine any current year income gains and losses and any prior year unallowed losses to see if you have an overall loss from the PTP. Include only the same types of income and losses you would include to figure your net income or loss from a non-PTP business activity. Number two, if you have an overall gain, the net gain portion, that is the total gain minus total losses, is non-passive income. On the form or schedule that you normally use, report the net gain portion as non-passive income and the remaining income and total losses as passive income and loss. And then to the left of the entry space, write PTP. And three, if you have an overall loss but did not dispose of the entire interest in the PTP to an unrelated person in a fully taxable transaction during the year, the loss is allowed only to the extent of income, and the excess loss is carried forward to use in a future year if you have income to offset it. Report the portion of the loss equal to the income as passive loss on the schedule or form you normally use, and then report the income as passive income on the form or schedule you normally use. So what this is essentially saying is, let's just suppose that you've got that rental activity, you've got the S corporation restaurant activity, and now you've also got a PTP activity. Your PTP loss cannot be offset by income from either of the other two activities, but the rental activity and the S corporation activity absolutely can offset each other, but your PTP cannot affect either of those other activities. For example, if you have a profit on your PTP, you cannot use that profit to offset losses from other PTPs or from either of the other activities. Also, your losses on any particular PTP are suspended and carry forward each and every year until you dispose of at least some of your interest in that activity. But interestingly, you don't have to completely dispose of your interest in the activity. So let's just suppose you own 1,000 units in a particular PTP, and you have some losses that you have been accumulating over time associated with those 1,000 shares. The day comes where you sell 500 of them and you realize a substantial amount of income from that sale. In the year you realize that income, you are now going to be able to offset that income from prior year's suspended losses from that PTP. Activities that are not passive activities. The following are not passive activities. A trade or business activity in which you materially participated for the tax year. So the following is not a passive activity, and that is a working interest in an oil or gas well which you hold directly through an entity that does not limit your liabilities, such as a general partner interest in a partnership. It does not matter whether you materially participated in the activity for the year. And this oil and gas well one, we don't see a lot of that here in Oregon because this just is not oil country up here, but you may live in an area where it's not uncommon at all for people to hold interest in oil wells. And the interesting thing about those oil wells is the income from them is subject to self-employment tax. And even though you may do nothing at all with relation to the oil well, the fact that you have an interest in it is all it takes. It is considered to be non-passive, and it is also subject to self-employment tax. The next one in line that is not a passive activity includes the rental of a dwelling unit that you also used for personal purposes during the year for more than the greater of 14 days, or 10% of the number of days during the year that the home was rented at fair rental, and an activity of trading personal property for the account of those who own interest in the activity, and finally, rental real estate activities in which you materially participated as a real estate professional. Rental income that is reportable as self-employment income. If you provide significant services that are primarily for your tenant's convenience, such as regular cleaning, changing linen, or maid service, you do not report your rental income on Schedule E. Instead, report your rental income and expenses on Schedule C. Rental income from real estate and personal property leased with real estate is not included in earnings subject to self-employment tax unless either of the following applies to you. You are a real estate professional or you provided services to your tenants. So let's look at what a real estate professional is. You are a real estate professional if you are engaged in the business of selling real estate to customers with the purpose of making profits from the sales. Rent you receive from real estate held for sale to customers is subject to self-employment tax. However, rent you receive from real estate held for speculation or investment is not subject to SE tax. So you could have very easily a client who is a real estate professional and may be purchasing properties, fixing them up and flipping them, and renting them out while they are for sale. And simultaneously going on aside that same rental real estate professional could have other properties that are not considered to be held for sale to customers. And in fact, I had a client like this for a number of years. He was a real estate agent. He owned a rental property on the coast, and he'd owned it for a number of years. He actually had a real estate company that managed it for him. And then locally, in the business of selling real estate, once in a while he would come across a property that he would say was a good investment. You know, it was a good deal, it was underpriced, needed some fixing up, and then he thought he could buy it, fix it up, and then flip it quickly. That would be a good example of being self-employment income from the fixer-flipper. Fixer-flippers can be self-employment if this is a person that's doing this on a professional basis. If it's just a kind of a one-off thing, you buy a property, fix it up, and sell it, you can probably swing it through as capital gain income. But if you are regularly involved in real estate and you purchase a fixer-flipper for the total purpose of fixing it and flipping it as a real estate agent, it's going to be self-employment income. But let's just suppose during the time that it is available for sale or held for sale, you actually have a tenant living in it, and that tenant is paying you rent. IRS says that is going to be self-employment income as well. Another form of rental income that becomes self-employment income is a trailer park owner. Rental income from a trailer park is subject to self-employment tax. You are a self-employed trailer park owner who provides trailer lots and facilities and substantial services for the convenience of your tenants. You are generally considered to provide substantial services for your tenants if they are primarily for the tenant's convenience and normally are not provided to maintain the lots in a condition for occupancy. Services are substantial if the compensation for the services makes up a material part of the tenant's rental payments. Examples of services that are not normally provided for the tenant's convenience include supervising and maintaining a recreational call provided by the park, distributing a monthly newsletter to tenants, operating a laundry facility, helping tenants buy or sell their trailers. And examples of services that are normally provided to maintain the lots in a condition for tenant occupancy include city sewage, electrical connections, and roadways. So if you own a trailer park and the only thing you do is lease out spots and you do nothing to manage the park, you don't operate coin laundry, you don't do a newsletter, you don't offer to help sell any of the trailers, then you might swing it off as just being a passive activity rental thing. But odds are that that trailer park is probably going to be a self-employment going concern type of thing. But if the only thing you do is provide hookups to utilities and a road, then you're not deemed to be doing anything that would cause you to be self-employed. The next one to look at is hotels, boarding houses, and apartments. And there's kind of a difference here, something to be worth thinking about. Because we're kind of in an era now where we've got clients that may be moving into this boarding house realm and not really knowing that they're crossing that line. And I'm looking at those short-term rentals where people can book rooms in your house over the internet. So when they come, you're providing them with a catered meal, you're providing them with a room in your house, you're socializing with them, and in other words, you're almost turning yourself into a bed and breakfast type situation, except that people are able to book online. You got to watch out for that, because if you're doing that, you've moved into the realm of self-employment. You've moved into the realm of a hotel or a boarding house. Rental income that you receive for the use or occupancy of hotels, boarding houses, or apartment houses is subject to self-employment tax if you provide services for the tenants. Generally, you are considered to provide services for the occupants if the services are primarily for their convenience and are not services normally provided with the rental of rooms for occupancy only. An example of service that is not normally provided for the convenience of occupants is maid service. Examples of services that are normally provided to tenants include providing heat and light, cleaning stairways and lobbies, and collecting trash. And the final topic we're going to look at very briefly today is rental income from farm rentals. And this is a very specific type of farm rental income. If you're not in the business of farming or you don't live in farm country, it will seem a little bit odd, but it is a very specific criteria that IRS has set aside to be treated differently from all others. If you were the landowner or sublessor and did not materially participate in the operation of the farm and rents you received were based on produce, grains, or crops or livestock that were produced by the tenant, report your farm rental income on Form 4835 instead of Schedule E. So in other words, if you own land and the tenant, instead of paying you cash for the rent of your land, gives you a share of the income from the product produced by your land, you're going to be reporting that on Form 4835 instead of Schedule E. Now, under both the cash and accrual methods of reporting, you must report livestock or crop share rentals received in the year that you convert them into money or its equivalent. Determining the character of a farm rental income, and this comes from IRS Publication 225, which is the Farmer's Tax Guide. You can find the reference on pages 71 and 72. As a general rule, income and deductions from rentals and from personal property leased with the real estate are not included in determining self-employment earnings. However, income and deductions from farm rentals, including government commodity program payments received by a landlord who rents land, are included if the rental agreement provides that the landowner will and does materially participate in the production or management of production of the farm products on the land. Crop shares. Rent paid in the form of crop shares is included in self-employment earnings for the year you sell, exchange, give away, or use the crop shares if you meet one of the 4 material participation tests that we're about to describe at the time the shares are produced. Feeding such crop shares to livestock is considered to be using them, and your gross income from figuring your self-employment earnings includes the fair market value of the crop shares when they are used as feed. So let's look at these material participation rules for landlords. You materially participate if you have an arrangement with your tenant for your participation and you meet one of the following tests. That is, you do any three of the following. You pay using cash or credit at least half the direct cost of producing the crop or livestock. You furnish at least half the tools, equipment, and livestock used in production activities. You advise or consult with your tenant, or you inspect the production activities periodically. Well, you only need to meet one of four tests. And to meet the first test, you have to do any three of the following. So can you say that you did all of the three of number one? If you cannot argue or show that you did three of number one, then you fail test number one and you go on to test number two. Under test number two, you must regularly and frequently make or take an important part in making management decisions that substantially contribute to or affect the success of the enterprise. And if you didn't do that, then you move on to step number three. You worked 100 hours or more spread out over a period of 5 weeks or more in activities connected with agricultural production. And if you don't meet that test, you finally move on to test number four, where if you do things that considered in their totality show that you are significantly involved in the production of farm commodities. These tests may be used as general guides for determining whether or not you are a material participant. And then the IRS provides this particular material participation test. Drew Houston agrees to produce a crop on J. Clark's cotton farm, with each receiving half the proceeds. Clark advises Houston when to plant, spray, and pick the cotton. During the growing season, Clark inspects the crop every few days to determine whether Houston is properly taking care of the crop. Houston furnishes all labor needed to grow and harvest the crop. The management decisions made by Clark in connection with the care of the cotton crop and his regular inspection of the crop establishes that he is participating to a material degree in the cotton production operations, and the income Clark receives from his cotton farm is included in his self-employment earnings. So this is really a test. These tests here are used to determine whether you are materially participating. If you are materially participating, then you wouldn't be filling out this form 4835. 4835 is only filled out when you own land and you are being paid for the use of your land through these crop shares or other income from the product of your land, and you can at the same time show you're not materially participating. These were tests to determine if you are materially participating. And if you are materially participating, then you have a farm, and farm rental income is not reported on Form 4835. If you are a tenant farmer, you should use Schedule F to report farm income and expenses. And if you are a landowner and you materially participated in the operation or management of the farm, you should also use Schedule F to report farm income and expenses. If you are a landowner or a sublessor and received cash rent for pasture or farmland that is based on a flat charge, you would use Schedule E to report that income. And if you are an estate or trust with rental income and expenses from crop or livestock shares, you should also report on Schedule E Part 1. And finally, if you are a partnership or S corporation with rental income and expenses from crop and livestock shares, you would not use that Form 4835 either. So that 4835 is specifically used only by individuals who are being paid through crop share and are not materially participating in the activity. The final category, where you are a partnership or S corporation who has rental income and expenses that come from crop sharing, those would get reported on 8825 and not get reported on 4835. Form 4835 itself is used to report the following kinds of rental income from farming production activities where you did not materially participate in the farming activity. Income you received from livestock, produce, grains, and other crops based on production. Under both the cash and accrual methods of accounting, you must report livestock or crop share rentals received in the year you convert them into money or its equivalent. Total distributions from cooperatives, such as those shown on Form 1099 PATR, which represents taxable distributions received from cooperatives. Also, agriculture program payments you received, CCC loans that are forfeited even if you reported the loan proceeds as income, and finally, crop insurance proceeds. So this is Form 4835, and you can see it's a fairly complex form. I've done no illustrations to help you figure it out, but it does divide up the types of income you receive. For example, income from production of livestock, produce, greens, and other crops. Cooperative distributions are shown on Form 1099 PATR. Agricultural program payments, commodity credit program loans, crop insurance proceeds. It wants to know where those different types of income come from, and then you total those up on line 7 to get your gross farm rental income. We move on to expenses for farm rental property. Do not include personal or living expenses, it says, and it wants you to go through and enter any of the costs that you had relating to this rental income to arrive at your final amount. And once you arrive at your final amount, the very fact that you're reporting on this form means that you are, by definition, engaged in a passive activity, and you're going to have to determine through use of Form 8582 whether or not any of passive activity loss is going to be limited. If you have income, you are going to be reporting the income, but if you have a loss, you're going to have to figure the loss on Form 8582 to determine if it's allowed. So that concludes the lecture part of today's class. I have one quick classwork assignment to show you before we sign off today. And it's a similar assignment to what we had in the morning class on rental property, the same character, but we mixed things up a little, threw in a couple of K1s to add a level of complexity to it. So I'll read you the problem, and then we'll go over the answer key, and we'll call the day done. And the forms needed to complete this assignment are fairly substantial. We're going to have to do a 1040, a Schedule E, an E page 2, as well as a 4562, a 6198, and an 8582. In December of 2013, Rudolph Deere bought a condominium apartment to live in, and instead of selling the house he had been living in, he decided to convert it to a rental property. Rudolph then selected a tenant and started renting the house on January 1. He collected $13,200 of rent for the year. Rudolph had the following expenses for the house during the year. He paid mortgage interest, fire insurance, miscellaneous repairs, real estate taxes, and cleaning and maintenance, and he has the following depreciation schedule to account for the year. You can see that the rental house was placed in service on the first day of the year, and then he made some other improvements during the year. Rudolph received a W-2 and 2 Schedule K-1s as shown next. Rudolph is a passive partner in Reindeer LLC, and his capital account is accurately reflected on the K-1 that he's receiving from that particular partnership. He is also an active partner in Toymakers Inc. Rudolph's capital account at the beginning of 2014 in Toymakers Inc. was 0, and during the year he contributed $2,000 to the business. Go ahead and prepare his federal return. So here's his W-2 showing $50,000 of income, and then we have 2 K-1s. Reindeer LLC is the partnership activity in which he has a $10,000 loss. And Toymakers Inc. is the S Corporation activity in which he has a $5,000 loss. So remembering these 2 losses that he has, $5,000 and $10,000, let's look back at these rules again. He is a passive partner in Reindeer LLC. So what does that mean about that passive loss? Is he going to be allowed to claim it? And then he is an active partner in Toymakers Inc., but he has a basis of 0 at the start of the year, and he's contributed $2,000 to the business. So how is all of that going to translate? And then on top of it all, he has this rental activity. So let's pull up the answer key and take a look at it. All right, so here we are on the answer key. There's a verbal description of what's going on in terms of calculating the depreciation and the completion of the Schedule E. I'm going to leave that to you to read through on your own if you're interested in that. But let's begin at the top, second page, where we talk about completing Schedule E page 2. We're going to complete Schedule E page 2 to report the income or loss from the passive activity and from the non-passive activity. Rudolph is a passive partner in Reindeer LLC, and therefore his losses are going to be limited to his passive activity income. And to determine what his passive activity income is, we should first see if we calculated any passive activity income. So let's just jump over to the Schedule E that we prepared for Rudolph Deere. He had $13,200 of income. We figured that his depreciation deduction is $3,033, and then entered all of the other expenses that he had. He turns out to have a $77 profit. So what that means is he has $77 of passive activity income. Bearing that in mind, let's go back up to this Reindeer LLC thought. And on Reindeer LLC, he is a passive partner that has amounts at risk in the entity. And so he has lost $10,000 for the year, but his loss is going to be limited to his other passive activity income, which is $77, and that means he's going to have a carry-forward loss to next year of $9,923. We then move on to Toymakers Inc. Rudolph is an active participant in Toymakers Inc. However, his adjusted basis in Toymakers is less than his share of the losses. Rudolph must complete Form 6198 to calculate and report his at-risk amount and the allowable loss for the year. His share of loss from Toymakers is $5,000, and he started the year with zero basis, but he contributed $2,000 during the year. So let's go ahead and prepare a 6198 for him so that we can figure out how much loss he's going to be allowed to claim. So we show on line 1 of Form 6198 that he has a loss of $5,000, and then on line 6 we show his adjusted basis at the first day of the year, which was 0. We then show on line 7 contributions of capital he made during the year of $2,000, and ultimately that leaves him with a basis in the company of $2,000. He will be allowed to offset $2,000 of his loss, and that means he's going to have a $3,000 loss carry forward to the next year. Well, let's carry this back up now to the Schedule E, page 2. On Schedule A, page 2, we're going to enter each of the activities. We have the Reindeer LLC activity, which is a partnership, and we have the Toymakers Inc. activity. And you can see that next to Reindeer, we've not checked the box, but next to Toymakers we have, because it says check if any amount is not at risk, and that is the case for Toymakers. We then show the passive loss that is allowed, and we show the non-passive loss that is allowed. Those two amounts total $2,077. And then we're going to show his total income or loss for the year, which ultimately is $2,000. And the reason it's $2,000 is because he's going to be allowed $77 of loss against the $77 of profit off of the rental property. And once the $77 of loss is offset by the $77 of profit, you have a round number, which is the loss on Toymakers that he is allowed to claim. And that loss carries up and is, of course, entered here on line 17. And the next form to show you would be the 8582. Right here on the 8582, we show the profit coming from the rental property. We show the loss from Reindeer LLC, and then we ultimately, you don't see it on here, oh, down here at the bottom, we have the total loss allowed for the year on Reindeer LLC is 77, and then this number here on line 4 is the carry forward to next year, $9,923. So that concludes the review of the classwork answer key for Rudolph Deer, and that concludes today's class on passive activity loss and at-risk limitations. Thank you for participating in today's class, and I hope to see you again soon. Bye-bye. Password number 2 is EMU. E-M-U. EMU. We hope you've enjoyed this tax education class. Pacific Northwest Tax School is approved as a CE provider by the IRS and the states of Oregon, New York, and Texas. We have been awarded the Quality Assurance Standard by NASBA and meet the CE requirements for CPAs in most U.S. states and territories. Tax clients demand knowledge and experience. Pacific Northwest Tax School provides the in-depth, practical education needed to improve your understanding of tax law and to meet the demands of the competitive tax preparation industry.